I'm very excited to introduce our next speaker, Dan Brocklebank. Dan is the head of Orbis UK. And I listened to Dan at the annual Allan Gray Investment Conference in Cape Town last month. And I found his presentation incredibly useful and timeless, as you know, given what we're going through in the market. His presentation reminded me a bit of an episode I had with my son. My son was about 4 years old at the time, and he was about to board on his first flight. And being a 4-year-old new generation kid, he is quite familiar with YouTube, and we spent a lot of time talking to him about flying. And eventually he got to the place where he could explain to us how airplanes fly. But he could also explain to us what causes turbulence. And this was I thought was quite good that he was addressing what we thought was a key issue, which is how he would respond when he experienced turbulence for the first time. And so he explained to us about air pockets and all of this and how airplanes fly. And we jump on the airplane, and you know, as we say in Durban, Trus Bob, we have some turbulence. And he went very quiet, and he started coloring in his book, and he kept saying quite loud, "We're gonna fall. We're gonna fall." And you know, he kept saying, and he started freaking out a lot of people, because there's this kid he's just looking at his coloring book and coloring and saying, "We're gonna fall." And he was convinced that the airplane was going to fall out of the sky. But I think it's not too dissimilar with investors, where you know, we talk about market volatility, we talk about market weakness, and when you're growing your capital to stay ahead of inflation, you will experience that, and it's as uncomfortable as some of the turbulence. And I found Dan's presentation really addresses that you know, when we started talking to Eli on the flight, we were able to distract him, that when the turbulence passed, he could then enjoy the flight a bit more. So on that note, Dan, I'm going to ask you to introduce yourself and what you do at Orbis, and take us through your presentation.
Sure, and I guess it's good afternoon all around. Greetings from over here in London. Thank you very much for that kind introduction, Craig. As Craig said, my name is Dan Brocklebank. I head up Orbis's business here in the UK. I've been here for a while. I've been in investment team, but as of about 5 or 6 years ago, I was asked to take on this leadership role. So my passion is with the investment side of the business, but nowadays I spend my time making sure that firstly our clients understand where we are and where we're going. And also making sure, very importantly, that the culture at Orbis stays consistent with where it has always been, and Alan's view for the firm. Because just for those of you who aren't aware, Orbis is Allan Gray Limited's offshore partner. We are separate companies, but we are owned by the same foundation, the foundation that Alan and Jill set up just before Alan passed. So we are separate companies, but we share very much a lot of similarities. Now, just to kick off, I'm just going to get my presentation up there and check that that is all working. Make sure I share the right screen. Can you see that okay, Craig?
Yeah, there we go. We can see it.
Have you got that up there? I will just say before I kick off, it was a real honor to be asked by Craig to come back, having seen the presentation, and do it again for you. I must say that honor was tinged slightly. In the preparation, we had a call yesterday just to prep for this and make sure everything worked okay. He dropped in that last time at this conference, the person in this speaking slot was, in his words, taken out by lightning. Now, I assume it was his building taken out, but it did make me slightly nervous. If I disappear suddenly during the call, maybe it will be proof that lightning can strike twice, but I hope to make it through intact. Okay, so to kick off, my brief actually came from Allan Gray and the team there. And they asked me, they gave me a very simple brief, and they asked me basically to answer these. Oh, let's just check we can get this moving on. Here we go. To answer these three questions. But as it is with Adam Gray, they said, when you're coming over and, when you're speaking to people, you've got to bear in mind that for many people, it'll be the first time they've had an in-person presentation since COVID. And they like to wind us up a bit and put the pressure on. So they said, so you better make it, we're expecting a really high quality presentation from you. They were piling the pressure on me a couple of months ago. So I thought, oh, thanks, guys. And as I sat back and thought about it, and I said, well, what can I use to make this one a little bit different? And thankfully, I have in 2022 been through a bit of a milestone. It's not a big birthday, and it's not the milestone that I'm most looking forward to, which is the last of the school fees. But the milestone was instead the 20-year anniversary of my joining Orbis. Now, we don't make a big song and dance about these sort of anniversaries at Orbis, but when you go through them, you can't help but reflect on some of the lessons that you've learned along the way. And I've done that a little bit over the course of the year, and it's been fascinating. So I thought what I could do today to try and make this presentation a little bit more interesting is to answer these three questions. But in doing so, I'm going to try and wrap them around 5 of the key things that really jumped out at me when I reflected back on my last 20 years following markets, but 20 years at Orbis, but 20 plus years following markets in generally. Because if there's one thing I've learned over those 20 years, it is that as humans, we are just not designed to be good investors. Our natural instinct pulls us away from what we should be doing. And so what I want to do is share with you 5 old truths. And hopefully by adding these into this presentation today, I will give you some thoughts that might be, or some insights and reflections that might be helpful for you on your investment journey. Because I'm sure many of you looking at your statements or at the news, will be feeling a little bit sore after this year. It has not been an easy one for anyone. So the first thing I can do is provide you some consolation and reassurance. You are not alone in that. This has certainly been a challenging year, but hopefully these 5 old truths will help you thinking through. So let's kick off and dive straight into the first one. Number 1, actors change, the movie doesn't. Or as has been said, history may not repeat itself, but it certainly rhymes. Now, it's really interesting when you think about why this might be the case in financial markets. And one of the core reasons I think this is true is because if you think about what's happening every 20 years or so, a new cohort of investors enters into the financial markets. And they are coming in their 20s or 30s, maybe in their 40s, but certainly in the 20s or 30s, coming into investing for the first time. And if you've dealt with 20 or 30-year-olds recently, they tend not to be short of self-confidence. And on roughly the same sort of time frame, we get these new technologies come along, some new insights, some new way of doing things. And when you find those things collide, they can be very powerful. If you think back over time, the introduction of new technologies have often been at the root of investment manias. I remember very vividly in the late 1990s, in my last job during the dot-com bubble, a manager of mine was literally spending all of his day trading internet stocks, dot-com stocks at the time. And given that we were both working for an accountancy firm at the time, we should have been auditing or doing tax returns or something. And this really was quite unusual. And I think this sort of mania that emerges from time to time is driven, on one level, it's by the allure of making easy money. But kind of probably most fundamentally, it's driven when people see others around them, other people around them making easy money. I remember very vividly going into this manager's office one day and him saying to me, Dan, it's absolutely fantastic. I paid for my wedding day trading on these stocks. And I was like, that's pretty amazing. I said, look, but this is clearly unsustainable. You should bank it and you should stop. And he goes, well, yeah, I know you're right. And I'm going to do that, but I've got to pay for the honeymoon first. And that was literally within a week or two of the top of the market. I was invited to the wedding, but it did have to be slightly scaled back from his original plans as it took off later that year. Now, the reason I mention that is because the era that we're going through at the moment feels very much like the period when I joined Orbis back in 2002. There are many similarities. The new technology that's been around today, that's been sparking a mini mania, is the idea of cryptocurrencies. I'm sure you're familiar with them, or at least have read about them. I'm not going to go into them in any particular detail, but I am intrigued when people describe Bitcoin as digital gold. It sounds a great idea, but to my mind, at best, it's a half-truth, because Bitcoin may be finite in supply, but the reality is that there's no shortage of other cryptocurrencies competing for Bitcoin's place. And it's not hard to see why cryptocurrencies have become the center of a mania. Some people have made a lot of money out of them. They're exciting. The new technology is fascinating. And I think this time around, the FOMO effect, the fear of missing out, has really been amplified by social media. But the point of mentioning this today is actually not to talk about cryptocurrencies. The fundamental point that underlies the first of my old truths is just a reminder to everyone that what we're dealing with as investors is not just logic and cold common sense. Investing is at least as much about psychology as it is about those things, about logic. Said slightly differently, what we're dealing with as investors is how we cope with this chart. And the traditional pattern, if left unaffected, is that as humans, we tend to get greedy when everyone else is excited, and we buy near the tops and we sell near the bottom. That is what our human nature is pushing us towards. And fairly obviously, it's pretty much the diametric opposite of what you really want to be doing. And really, I wanted just to, in my first old truth, just to remind everyone that this is the real challenge that we're having to do, and reassure everyone it's hard. It is not easy. It does not come naturally to the vast majority of people. So what of that old manager of mine? I was amused to see a couple of months ago that he's launching a new venture. This time his new venture is in NFTs, which are sort of offshoot of the crypto world. So if his history is anything to go by, it probably means that we really are closer to the top rather than the start of this particular mania. And frankly, let's hope so. So that's old truth number one. Old truth number two is a little bit of an extension of that, because it's really saying, we know, I think most people intuitively know that human nature causes these cycles. But what's not taught in business school, and you can't read about in the textbooks, you have to learn the hard way, is that these cycles often overshoot by far more than you can possibly ever imagine beforehand. And I first learned this when I was working with Alan Gray on some Japanese companies. And actually, when I was working with him on this company in particular, I'm sure you're all familiar with the company. But we had a thesis back in late 2002 that Toyota, and you can see the share price line here, share price had gone nowhere for about 6, 7, 8 years. And the yellow shows the earnings per share, the profit per share. And that had started to creep up again. And the shares were trading at a pretty modest 12 times earnings. And when we looked at the market for Toyota with its product suite, its product offering, and its market positioning, it was pretty easy to come to a conclusion that the growth potential for Toyota at the time was very strong. And at 12 times earnings, we thought that represented pretty good value. And so we initiated a position in late 2002. And basically, we were right. I mean, the earnings per share went up. And the share price kind of did okay, but did nothing particularly special. What was going on, though, if you looked underneath the hood and when you analyzed those earnings, is that as the yen started to weaken over this period, Toyota was an exporter of cars. And so increasingly, that earnings growth, that the profitability growth, was driven by the currency depreciating as much as it was by them selling more cars. And we got pretty bearish and a little bit nervous about the sustainability of that. And so in just mid-2005, we took the decision to sell the position and reallocate the capital to other opportunities. Now, unfortunately, from our perspective, that that currency weakness, that cycle in the yen, was only really just getting going. And earnings continued to grow for substantially for a period of time. And in fact, they ended up being up almost 4 times over 6 years. And by the end of that period, really, the yen was very, very weak. It's only really just past that weakness very recently. So the echoes with that period today are very strong. And by the end of that period, the vast majority of the earnings growth was coming from this yen weakness. And you would expect that the market might be getting very skeptical about this. In fact, rather frustratingly for us, the opposite was true. The market wasn't really looking at the quality of the earnings so much as just looking at the consistency of the earnings growth over the last period. And the shares, not only had the profitability grown, but the market put a higher multiple on those earnings. And as you can see from the chart, in 2007, the share price was extremely high. Now, it did eventually come back down towards a sensible multiple of those earnings. But it was a painful couple of years for us watching the shares double in the 2 years after we'd sold them. And there is another modern day echo of this in today's market, probably even more extreme. I'm sure you're all familiar with Tesla and how expensive it has been. This is really a bit of a Tesla update. And I've plotted the profitability on here. You can see it had an incredible run starting in about 2019. But this time what I've done is, rather than plot it against its own metrics, I plotted Tesla's share price against the profits of the whole industry. So you can see from this chart that Tesla is trading at about 7 times, was trading at its peak at about 7 times the profits of the whole industry. Now that might be cheap if there was no competition and the company was a monopoly. But clearly that's not the case, and there are plenty of other vehicle manufacturers about to launch excellent, and perfectly good electric vehicles. So the competition is only really just hotting up for Tesla. One way of telling that the share price and the market as a whole is in something of a speculative mania, though, is not to look at the valuation, is also to look at the trading patterns. And in the yellow bar here, you can see how many days it's taking for the entire market cap of Tesla to trade. And you can see that in recent years, the market cap of Tesla has turned over every 20 or 40 days. If you think the average shareholding is 40 days, you can pretty much be confident or certain that the shareholders on average are not thinking about how the fundamentals of that business are going to play out over the long term. This has become a very speculative situation. Now, why do I mention all of this? Because I think both the cryptocurrencies and Tesla are symptoms of that. Up until really quite recently, we've been operating in a very speculatively driven and liquidity-driven market. And when you see those markets, they present a fundamental headwind for investors like ourselves, which are focused on the underlying fundamental valuations of those markets. And you can see that if you look at our returns over recent periods. What I'm doing in the charts here is I'm plotting the annual returns of the Orbis Global Equity Fund. So it's the annual returns after all fees. And just to be clear, this is up until the 31st of August. So the left-hand bar is the per annum chart over the last 3 years, the middle bar is over 5 years, and the right-hand bar is over the last 10 years. These are in dollars, so translated back into rand, it would look a bit better. But I've just used dollars for now for reasons you'll see in a minute. Now, I would describe these as lackluster as best. And as a South African audience, renowned for speaking directly, so feel free to use slightly more choice language here. But these have been disappointing. We feel these very strongly. What makes them, to be blunt, even more uncomfortable is if I compare these returns to the returns of the world index. And that's what I'm doing in the lighter blue charts here. You can see we have underperformed, particularly over the last 5 years, but even over the last 10 years. And there is no getting away from this. This is a very uncomfortable chart to be showing. We feel this very directly and on behalf of clients. So this is not a good position to be in. But I'm putting it up to help you understand, and because I think it's useful to drill into what it is that's been driving those returns of the world index. Because one thing we can say that it hasn't been is that it hasn't been small cap stocks. If you look at an equal weighted index, That's performed significantly worse than the world index. The market has been driven by big cap stocks. Also, value overall has underperformed. So this is a market that's been driven by growth stocks. We've beaten value, but obviously we haven't kept up with the index as a whole. And the market certainly has not been driven by emerging markets. Emerging markets have been particularly weak. And we, driven by the fundamental valuations, we've been overweight all three of those areas, and that has certainly hurt our returns. So what is it that has been driving the world index over these last periods? Well, no prizes for guessing. I'm sure many of you will be well aware what it is that's been driving it. It is, of course, the US. And the US market, particularly the big cap US names, have been frankly pretty extraordinary in the returns that they have delivered. Now, overall, this picture is very, very uncomfortable, but underneath it all, I don't think it's unrealistic or falsely optimistic to say that this does present significant opportunities, because the outperformance of the US has certainly been extreme by pretty much any measure. The US as a whole makes up over 65% of the world index at the moment. So that is very, very extreme. And history just shows you that when you see these extreme moves from a portion of the market, it prevents substantial opportunities for investors, provided that you don't get sucked into trying to jump onto the bandwagon towards the end of that bull market, in this case, in big cap US names. And I don't think it's unrealistic either to say that we are starting to see some green shoots, and particularly, well, certainly so far in 2022, but also year to date. I think you can see those green shoots of optimism in a couple of different ways. But I would just say I hesitate to describe anything about 2022 as being good news. Clearly, markets overall have been very weak. I'm very conscious of that. The world index, has been down in total by about 17%. The silver lining is that as a result of our fundamental approach and what I believe is going on underneath the surface, we have been able to predict the downside to a certain extent, and we have outperformed by 4.4%. I think it's still relatively early days. Qualitatively, what's helpful is that when you look at what's driven that, it is the companies that we've been saying look the cheapest and look the most undervalued. So qualitatively, that is encouraging, but that is still only a short period. I think what is better news, or what is more material in terms of the good news front, is the opportunity set today. Because despite what we've seen today, we believe that the opportunity set remains unusually wide. And this chart illustrates that, and it's a little bit unusual. You may have seen versions of this over time. We've talked about it a little bit in the past. But in essence, what I'm showing here is an objective output from our quant system. So we can't make this up. This is driven by our formulaic, the data the historic data in our system. And what the line shows is the spread between the most expensive half of the market and the cheapest half of the market. So it shows the valuation gaps, if you like, that are available in the market. And the way to read the chart is that when the line is high, means the gaps between the cheapest and the most expensive stocks are particularly wide. Now, if you think about it from a value-driven or value-oriented manager, what it means is that when that line is trending upwards, when the gap is getting wider, expensive stocks are getting more expensive and cheaper stocks are getting cheaper. And that is the nightmare scenario for us. And you can see we've really been in that environment for much of the last decade, and particularly for the last 5 years. We were excited about the valuation spreads on offer back in 2019, but as you can see, the last couple of years, as a result of COVID, there was just this super extreme blow off in those valuation spreads that happened because COVID really exacerbated all of the tailwinds for these big cap companies, the big cap tech companies. So even if you just take out that COVID period and we were at today's level, which is shown by the orange line, you can see that compared with periods of history, we are at extreme levels of valuation spread. And that says to us that objectively the opportunity set is wide. And just looking back at the periods where the spreads have been wide, in 1990, they went on to be good periods of alpha generation or outperformance generation from our perspective. So fundamentally, that's the core reason today why I remain very excited both to talk to you and as an investor in the fund alongside you, our clients. Growth stocks are still expensive today, although clearly we're in a dynamic situation. Some of you have seen the markets, some of the moves today. Things are moving back towards correcting slightly. So the opportunities, but now I want to bring it back to old truth number 2, which is that cycles overshoot often radically. I'm excited. I think that there's real cause for optimism, but I think it's really important just to understand what it is that's driven things in the background to create this opportunity set. And I think when history books are written, there are 2 long-term cycles that have just gone further than anyone ever would have expected at the outset. And to kind of see this, you have to pull back even further. And as hopefully you're well aware, at Orbis and Alan Gray, we like to take a long-term perspective. And so this chart is one that goes back, it only goes back over 700 years. It shows the history of bond yields, of sovereign bond yields. And you can see that even with the pickup, the recent bounce in some sovereign debt yields, on average, interest rates remain very, very low in historical context today. This has been fundamental in terms of driving market recently, and any normalization of this picture will be very bullish for normalizing or unlocking that market opportunity that we see. And then the second one, which the second extreme cycle that we're dealing with at the moment, is the performance of value stocks. And value has a long history of outperformance. Here you can see the last 100 years for which we can measure this. Value has a long history, which I think is intuitively supported. And I've heard some people say that with the bounce year to date, that maybe with all this, value has caught up. But if I just add on how this has looked over the last year or 2, you can see really we've only just started to head back to that trend line. So in my view, there remains a significant opportunity from this set. So that conviction we're seeing objectively is backed up by the fact that we have 2 long cycles that are really, really still at very extreme measures. And against that backdrop, it should hopefully be no surprise to you if I tell you that from a portfolio perspective, our value-oriented holdings are over 60% of our strategy. And in fact, they're pretty much at or close to the highest levels they've ever been, apart from perhaps right at the peak of the tech bubble. And what I want to do in the rest of this presentation is break down that exposure. And just to help you understand it, what I'm going to do is split it into 3 buckets to give you a feel for what we own and what we're finding as cheap in the portfolio at the moment. So the first of those is the bucket I'm going to call the deep value stocks. This is a pretty idiosyncratic bunch of names. You'll presumably recognize BMW and Samsung Electronics in there. ING is a Dutch bank. Jardines is a Hong Kong listed company. This is an eclectic group of companies with a long-term history, decent business, but overall as a group, they're trading at very cheap levels. They're trading about 8 times earnings for differing reasons, but none of which we think hold true over the long term. Now, to put that in context, the market overall is trading at about 20 times earnings. And the advantage when you have a big discount like that is that when you own companies that are so cheap relative to the market, it gives you a fantastic margin of safety. And it means one thing, that if you make any forecast about the business, you don't have to make heroic assumptions and you don't have to be that right. You just need these businesses not to absolutely fall apart for investors to be positively surprised and for there to be significant upside. And that observation brings me onto the next of the old truths, number 3, which is probably my favorite. I was fortunate enough 20 or so years ago, or probably 18 years ago now, to have been mentored by some of you, Simon Murray, who some of you may remember. He was the former chairman and chief investment officer of Alan Gray. He came over to London for a period, and I was lucky to learn an awful lot from him. And he used to love showing these charts. And old truth number 3 is that investors can't forecast well. And I'll show you why I think this matters. But just as a bit of a recap, probably the most famous examples of this are perhaps probably this one, for Business Week back in the late 70s. They forecast the death of equities and said how inflation is destroying the stock market. Just before the stock market went on to do this, just to prove it's not just bearishness that kicks in. A few years later, the book Dow 36,000 was published after the market had done this, predicted the new coming era of rising stock markets shortly before the market just did this. From my 20 years, my favorites are probably this one, Chairman of the Fed Reserve, no less, saying that we've never had a decline in house prices on a nationwide basis, shortly before house prices on a nationwide basis went on to do this. Probably the most amusing is a certain entrepreneur commenting that Doge has immense potential as a fiat currency, shortly before it went to do that. And maybe the reasons were something to do with what was going on in this photo. But I'll move on swiftly because I don't really want to be sued. Perhaps most fundamentally and most importantly, many of you may recognize that chart from the inflation trends over the last 20 or so years. It really has been a story of success and one of taming inflation. Lo and behold, Business Week jumped in with this cover. Excuse me, sorry. They framed the headline as a question, but I think given the fact that they put a dead dinosaur on the picture, they probably had a particular answer in mind. And in fact, if you look at the call out, you get a strong sense for where they were going with this article. In the article that they featured in there, no less than Larry Summers was quoted as saying, we're going to be stuck with low inflation and low interest rates for another 10 to 15 years at least, shortly before inflation went on and do all of this and to do that. And why do I mention all of this? It's not just a bit of fun, although it is kind of quite amusing, if you like, to see why we do this. The astonishing thing to me is not that we're bad at forecasting, because forecasting is very difficult. The world's very, very complicated. It's like forecasting the weather. Might be able to do it for the next 3 days, but trying to do it 3 weeks in advance is extremely difficult. What's more astonishing to me is really how much people continue to use forecasts and to refer to forecasts. And I think the reason people like to do that is a bit of a simple one. Here's a long-term chart of the stock market returns, the S&P 500. And what I've done is I've shaded the recessions over that time frame in the blue bars. And I think if you said to anyone, look, this is what your portfolio is going to do over 100 years, I think everyone would be pretty happy with that outcome. But if you look at it closely, what you can see is that the recessionary periods all tend to coincide with periods of stock market weakness. And I think when you come out of recession, people tend to say, well, it's pretty easy to fall. It must be obvious when the recession is coming, because it always feels obvious in hindsight. So if I spend some time trying to forecast when the next recession is going to happen, or when I next think a recession is going to happen, I'm going to move to cash, then they think they can maybe avoid the downturns and do better. And the big problem with that is that forecasting is hard, and it is particularly hard to forecast recessions. There is no evidence at all that we are able to do that. And thankfully, to prove this, the IMF came up with a very helpful paper, and they looked at professional forecasters, the people who get paid to do this for a living. How successful are they at correctly identifying a recession? And they looked at all of the forecasts, and they looked a year before a recessionary year. And so looking at the forecast in April, what percentage of forecasters correctly forecasted a recession? Have a guess yourself, bit of fun. The correct answer is that it was just 3%. Now, maybe we're being a little bit harsh, maybe asking people in April, when it's still 9 months away. So what about asking people in October? This is just 3 months before a year in which a recession kicked off. What do you think the success rate is? Well, I'll give you a clue. It is better, but still only 9%. It's absolutely staggering in my mind. And I would really encourage all of you to bear this in mind. If anyone starts out with a forecast or an economic forecast, be very suspicious as to, firstly, A, whether they're any good, because most people aren't, the vast majority of people aren't, and B, why they're saying this, because it is just incredibly hard. If you know that your forecasts are not going to work out, very hard to see that it's going to be useful. Why am I mentioning all of this? Well, let's go back to the portfolio. The reason I mention it is because a second group of companies, a second group of value-oriented holdings that we own today, are ones that are being affected by investors, other investors, I should say, certainly not us, playing this recession forecasting game. And this is a group of companies that we refer to as the quality cyclicals. And just to give a little bit of a recap, these are Global Payments, a payments company, XPO, GXO are in the logistics business. These are companies where we think they have a fundamental long-term competitive advantage. We really like the companies and the management teams. We think they've got a brilliant competitive position. But because of the nature of the industry that they're in, if a recession comes about next year, and it might, but it might not. If a recession comes about next year, there will be some short-term impact to their earnings. Now, the market is clearly getting very worried about the potential for recession next year, and so it's marking all of the share prices down in those companies. And some of them are trading at extremely depressed multiples. Overall, they're trading at 13 times earnings, which is a combination of people reflecting, firstly, the long-term growth opportunities that we see in those franchises, but then also pessimism about what might happen next year, because nobody wants to be willing to own these companies into a recession. Our approach, as you might have guessed, is just fundamentally different. We know that we can't forecast a recession, but we can have a reasonably good view on whether these companies are going to be good investments over 5 or 10 years. So as we see the markets, getting more pessimistic about the shares in the short term, our inclination is to add to these positions, and that's what we have been doing over the course of the year. So we're increasingly excited about being able to add to these at a time when investors are worrying about the next year or two and how bad that might be. Again, just for reference, the market overall is trading at 20 times earnings. So let's move on to the next of the old truths, which is old truth number 4. Investing has got to be about the future, not the present. Now, that's obviously not very, I wasn't able to get that into a very concise thing. I think you can summarize that old truth by the next picture that I'm going to show you. And have a look at this picture, because I think nothing captures what, as investors, we're trying to do better than this picture. Now, those of you who are really paying attention might say to me, hang on a second, Dan, isn't there a bit of a conflict here? Old truth number 4 says that investing has got to be about what the future looks like. And yet you just said to me that as humans, we're terrible at forecasting, which we are. How do I reconcile those differences? Well, firstly, I do think there is a conflict there. I think it is a very real challenge, and it is the challenge we face. It's kind of why investing is not simple and why it's not easy. But where I reconcile it with my mind, and where I think you can make a distinction, is that if you're trying to forecast specific timings or specific levels of GDP growth, you're trying to make precise forecasts, either about timings or rates of growth, that's incredibly difficult to do with any degree of accuracy over any consistency. But what investing is all about, and certainly what Simon taught me, investing is about spotting when markets are really at extremes, or when you might see an inflection point. He always used to talk about how I'm not interested if a company is earning $1 a share and you think it might be able to earn $1.10 or $1.20. I'm not interested in about that, because that's well within the bounds for error. I want to find companies that are earning $1 now, but which might be able to earn 3 or 5 in future, where the market is just radically wrong in terms of the potential for the company. I first learned about this actually working with Simon on an industry, and we were visiting a company in Dallas that made the rail cars that you can see in this picture, so the tank cars that are being pulled behind the train. We went to see the CEO and we had a meeting about his industry. But in the course of that discussion, he made an observation which I kind of noted down because it was interesting. He said, by the way, you should know that our customers, the railroad operators, are getting much better organized than we've ever known them. And this was back in 2002, 2003 time. At the time, there were 4 listed North American railroad companies. Sorry, American. There were 2 more in Canada as well. So when we got back from that trip, we dug in, and I must confess this is a painful story to recount, because it was on my part certainly a sin of omission. We dug in. We did a lot of work on the companies. We could see that yet there was some potential, but for various reasons we took a pass, and we didn't invest in the companies at the time. Unfortunately for us, that CEO's observation was actually spot on. And what was happening in the US rail industry was absolutely fascinating and has been very fundamental. The first thing that was happening was that the companies were getting themselves organized. To give you a sense for just how much of a basket case the industry was, back in, I think it was 99 or 2000, Union Pacific, one of the biggest North American railroads, they actually lost a whole train. The trains are 5 miles long, and they lost it. They did not know where it was on the network. So it was pretty shambolic. Many investors had said that these companies are just uninvestable because they are so poorly operated. And what was going on behind the scenes, though, actually starting with the Canadian railroads, but it spread to the US ones after that, was that the companies were getting their operations sorted. And fundamentally, they shifted their mindset as a management teams away from chasing market share and chasing volume, and they shifted towards trying to grow profit. That may seem obvious, and it certainly seems to be obvious to anyone with an entrepreneurial mindset, but for decades, since they were essentially liberalized, the railroads have been just engaged in chasing volume. And so this shift was very profound. They found that they were actually more like natural monopolies, and they were able to raise their prices, particularly once they got their operations sorted out and they didn't go losing their customers' possessions all around the country. Second thing that was happening was as they raised their prices, started growing their profits, the amount of cash flow that they had to reinvest went up substantially. They invested in their operations, but they had surplus free cash flows. That they were able to return to shareholders through a combination of steadily increasing dividends, but also by buying their own shares back. And the reason this was so powerful was the third factor. The third factor behind it all was that the companies as a group started out with very, very cheap valuations, largely because for 20 years they've been seen as uninvestable. And you'll see why this is a really painful episode for me to have to recount when I show you the share price chart. We all know the world index over time has basically done that. This is the world index since I did that work on what was with Union Pacific actually back at the time. And we know the US has outperformed over that period. So this is what the S&P 500 did over the time. To show you what the US rails as a group has done, I actually have to adjust the scale on the chart. So this is that same data just on a bigger y-axis chart. The US rails as a group since then have outperformed the S&P 500, let alone the world index, by about 5 times. This is very painful for me personally. But I mention it today for a couple of really good reasons, and I think it's really relevant to understand what's happened here for 2 reasons. Firstly, and again, certainly up until very, very recently, we saw big cap, big tech companies dominate the market. And when you see that pattern of performance emerge for such a long time, people start writing a narrative basically that starts, all you need to do to be successful investing is to do X. And because high return on capital tech companies had done very well over that period, the mantra sort of became, the only thing you need to do is to own high return on capital companies. And to do that, the place to start looking is to look for companies that have low capital requirements and low capital intensity. And I think what's powerful when you look at this is it's hard to imagine an industry that is more capital intensive than the railroad industry. And yet, despite that being the mantra from the last 5 or 10 years, the rails have outperformed the tech sector by an absolute country mile. So my suggestion is to be very wary of managers that say they only buy a certain type of company. Because good companies or great companies, we all like to buy great companies, but great companies can also be, can certainly be poor investments if you pay too much for them in the first place. The rails are average quality. They certainly started out as average quality companies at best. They were still able to be great investments over 20 years because the starting price was very, very attractive. The second reason, even more exciting reason for mentioning this and bringing this up today, why I think it's relevant, is that I think this episode and the conditions at the starting point back in 2003 are very analogous to another industry today. And this is why I really want to mention it today, because I think the conditions for the rails back in 2003 have a lot of parallels with what's going on in the energy sector today. And if I compare those three factors that drove the returns of the rails over this period, firstly, the shift from volume growth to profit growth. Well, in energy, we're absolutely seeing that. And we're seeing that across many different ways. One way to see it very quickly is to look at the capital expenditure across the industry. Now, when you're spending money on capital expenditure in the energy, in the oil and gas space, you're basically drilling wells. You're bringing new supply onto the market. This is the history of that drilling. And I've done it on a 5-year average because these tend to be quite long cycle investments. And this shows it up to about 2015. And what you can see, it has been a very cyclical industry in terms of that investment. This was up to the last peak. The last peak was shortly after the peak in prices. The industry has an unfortunate habit of historically maximizing investment just as prices peak. Now, where is that ratio today? Where is that reinvestment today in new supply and new capacity? Well, as you can see today, up until the end of 2021, that reinvestment looks like that over the last 5 years. And perhaps most powerfully, the 2021 number, bear in mind, this is a 5-year average. 2021 number is well below that long-term average. So what we're seeing on the supply side in the energy space is a fundamental collapse in reinvestment into this, bringing new supplies onto market. And it's no big surprise. It's no big surprise why this is happening. We have a real fundamental challenge about climate change and the use of fossil fuels. The ESG movement is, and politicians in various ways have said to this industry, we don't want you to exist. And if you're the management team being faced with that, well, the last thing you're going to do is drill wells that might be online for 10, 20 years. Doesn't seem to be a good use of money. So reinvestment has collapsed. And when you speak with management teams, they absolutely have made this fundamental shift away from chasing volume growth, and they're focused on profitability and maximizing the profitability of the business at the moment. They've also started dividends and buybacks. This chart shows the potential for just how big that can be. If you look historically, the yellow line shows the cash flow operations. So the cash flow that the companies have, that their existing production has generated. And you can see that overwhelmingly, that cash has been deployed into the dark blue shaded area. The capital expenditure has gone into building new wells and bringing new supply onto production. Some of that has then gone into dividends, and where the industry has, in periods where it's then had excess free cash flow, in the past it has returned money to shareholders through share repurchases. The absolutely staggering thing you should be able to see from the chart is just how big this increase in spare or excess cash flow is at the moment. So we don't know where this will play out over the next 3 years. We may see a resumption in capital expenditure. I'm not sure we will. So far, at least, we seem to be seeing that cash flow going back to shareholders, but we are watching that like a hawk. And the reason that could be very, very powerful is because, as with the rails back in 2002, the valuations are starting out from a very, very cheap level. This chart, in a nutshell, just shows essentially the industry has never traded at a cheaper multiple, trading at double-digit free cash flow yields, which is cheap by any metric, and in many cases we're up at 15-20% free cash flow yields. And if that cash flow starts flowing back to shareholders, basically means you get your money back in 3 to 5 years. So it's a really fascinating layup in the sector at the moment. With all that in place, it should be no surprise to you to say that the third bucket of the value-oriented stocks are ones that very much play into that theme. We like them individually, but that's probably the one thing uniting them all. They are what we call sort of critical infrastructure, energy and materials names, where fundamentally we think over the last 5 or 10 years, there's been a shortage of reinvestment in the supply side. Demand is there or thereabouts. It may be weak in the short term, but fundamentally the supply side challenges are driving markets. And this creates a very bullish layout. These companies as a group trade about 8 times earnings. Even if you normalize for prices, the PE multiples are still very, very attractive and a big discount to the world index. So that's the third bucket of value stocks. Now, the final old truth that I want to share with you today, and I'm conscious of time, is that, it can't be an Orbis presentation without me mentioning the contrarian word. And if there's one thing that's sort of fundamental to how we think about investing, is that you can't do the same as what everyone else is doing and expect to do better than the market. So underpinning all of our individual stock picks is something where we believe the market is different. And so a lot of what we do, and this kind of links back to my opening observations about investing being as much about psychology as it is about logic, a lot of what we do is to make sure we understand what is truly priced in by the market. And we look for essentially contrarian indicators. Often these can be quite hard to find, but I have to share with you that the most, and they do occasionally pop up in extraordinary places. And the one that stands out, will always stand out in my mind as the most extreme, was one I discovered in February of 2009. I'll ask you all to cast your minds back to where you were in February 2009. It was the midst of what we call in the UK the credit crunch. It was a pretty grim time at work, to put it mildly. Markets around the world were collapsing, and I'm sure the advisors on the call will remember that many clients, maybe some of you, were having fundamental doubts about the financial system, whether you wanted your retirement funds to be anywhere near the stock market for obvious reasons. Happily, though, in some ways, my wife was actually pregnant at the time, and the contrarian indicator arrived on the evening of the 3rd of February 2009, when my wife went into labor, and my younger son James arrived. It being February in the UK, it was cold and dark, and just to add to the jeopardy of the situation, there was a light dusting of snow on the road. So we'd moved house since we had our first child. So I didn't, if I'm honest, I didn't really know the route to the hospital as well as I probably should have done. James was in a hurry to get out as well. So it was a hectic and stressful drive, even without thinking the backdrop of what was going on at work. And I certainly probably wasn't ready to have another member in the household. I think it's very hard as parents to be prepared for it. I should have been better prepared for that journey. But I don't think anything could have prepared me for what the midwife said when James arrived. And she picked him up, and literally the first words he was greeted with in this world are words that have now been immortalized in our family. And they were the words, "James, welcome to the credit crunch." Now, how or why she ever thought that was a good idea to say that at that moment in time, I will never know. But I think one conclusion I think we can all take away from this is that when you're seeing economic commentary play out in the maternity ward, you probably are at an extreme in some market cycle or other. And needless to say, that was within weeks, if not days, of the bottom in the stock market. And what was, with hindsight, we know, a once-in-a-lifetime generational opportunity to buy stocks. Where are the contrarian areas today? I've talked a bit about value stocks. Chinese stocks, they're definitely contrarian. I'm beginning to think they're ones that you probably don't want to go anywhere near. So not all contrarian ideas are ones that are worth chasing. COVID hangovers, there are still some industries struggling to get back on their feet from a COVID perspective. Think aerospace. I think if I've got time, Craig, and just not if I have, I'll just share with you one example of what we call an ESG orphan. Before I dive into that, just fundamentally, we take our responsibilities as stewards of our clients' capital. We take them extremely seriously. However, unfortunately, I think we're seeing in many places a desire to oversimplify, with good intention, but oversimplify some of the challenges that the world faces. And the ESG movement is trying to oversimplify some of these things To give you an illustration of what I mean by that, one of the companies we own in the portfolio is a company called AES. It is an electricity generator. I mentioned in one of the dry runs that it's a bit like Eskom, but having been in South Africa a couple of times in recent months and having caught the tail end of the presentation about renewables, I can see why my colleagues in South Africa advised me not to compare AES to Eskom. But there is a clue as to why this is contrarian today in the picture. But if you compare AES to probably a better comparable, there's a company called Next Era Energy, which does a similar thing. Better branding, one has to say, given all of the thoughts about energy transition at the moment. But if you look at these metrics, the dividend yield's higher, growth rate's higher, and the share from renewables is higher at AES. I suspect most people would say, well, my choice just on that information would be towards buying AES. Now, if you look at valuation, however, AES is trading at a very, very steep discount to its closest comparable. So the obvious question is kind of why on earth is that happening? And I think the answer is actually very simple, and it lies in this metric, is that the percentage of AES's generation coming from coal is at 22%. Next Era has a bit, but obviously far less. And that 22% of its power generation from coal is enough to put AES out of bounds for many investors. I know I'm as a Brit, I'm got to be careful using cricketing analogies these days, but that puts AES out of bounds. And as I hope you would expect, our approach and our research on the company is much more detailed, and we go much deeper under the hood to understand the company rather than just dismissing it based on one static metric. And a couple of ways that I think are a couple of things to mention when you think about that valuation gap on offer. Firstly, AES is investing plenty of its free cash flow into renewable opportunities. They have a whole range of them, and I can bore you for hours on it, so I won't. But probably most fundamentally, when you look at that coal generation, rather than looking at a static number, we believe it's most important to look at the trajectory of that coal generation. And if you look at where that coal generation has come from, it started higher, but it was as recently as 2018 up at 50%. 2020 it was lower. It's come down to 22% today. And most importantly, by 2025, so well within our investment time frame, the share of generation that will be coming from coal is expected to be zero. Now, and to be totally clear, this is a good outcome. We are very, very supportive of this transition by the company. It's what society as a whole needs to do. But because we've got price agnostic sellers of the company, we've got people selling AES just because of this 22% coal generation, we have not only a great investment opportunity on our hands, but I think we also have the opportunity to do what is right. And as being active, engaged owners of the company, we're supporting management making the investment to help this transition happen, which is what they and society as a whole needs to do. So I think it's kind of hard to think of a better example of our approach to ESG, but also why it's kind of difficult, and being overly simplistic is just very dangerous in my view. Okay, so just to wrap up, these are the three questions that I was asked to cover. I think I've got there. Performance has been disappointing. I do not for a second try to hide away from that. We felt that directly. That said, it's important to see up until 2022, the market has been on a 10-year growth binge. Those differentials have been widening, which has been a real headwind for us. Specifically, we have had exposure to China tech and Russia, which has hurt us, but we'll always have things that haven't gone well. I think the bigger issue is this divergence in valuations that's been happening. How we position today, we have historically high value exposure, which is very exciting to me given the context. From a macro perspective, we're not wedded to one idea of the future. One area I didn't talk about is kind of the other non-65% of the portfolio. They tend to be pretty stable companies that are very defensive in names. So we have got macro stuff that will do well in all phases of the macro cycle. Above all else, I hope we are reassuringly contrarian, because that is the essence. That is what it takes to outperform. And then views on the outlook. Look, they put this in, and it always annoys me because I've just spent a section of the presentation saying how bad we are at forecasting. But I am genuinely excited about the prospect for relative returns. I put this presentation together when markets were a fair bit higher today. So I was a bit more cautious then. Obviously, the further they go down, the more enticing they can be. But I think specifically the value rebound could still have a very long way to go. And just prepare yourself. Recessions are inevitable. They will happen. We can't predict them. We're not trying to avoid them. We're trying to use them as source of opportunity rather than as things that would trip us up. I have some old truths now. I hope you enjoyed them. If I did have longer, I would have added 6, and that is that incentives always matter. And the reason I mention that is because I'm aware that there has been some debate in the South African market recently about fee structures. Very happy to take questions on that, and I would urge any of you to contact Alan Gray if you want the facts about our fee structures. However, it is fundamentally a bedrock principle for us, and it really goes all the way back to Alan's vision for the firm, that we should only be able to do well as an investment firm if our clients do well. And that is why we believe fundamentally in linking our fees to our performance. It means 2 things. It means that yes, we have bonuses, dividends have been down a lot in recent years. That's as it should be. But what it also means is that we're ruthlessly focused on that investment performance. And we're not just trying to launch new funds to be able to have something to sell, to gather AUM and to increase our AUM. Our focus remains above all else on generating that performance for our clients. I'm conscious that it has been challenging. I feel it, we all feel it, but I am genuinely excited for the next 5 or 10 years. And I do hope I'll get to come back on my 25th anniversary and celebrate a quarter century with you in South Africa, hopefully in person and not behind a laptop, which is always a challenge for everyone. But I look forward to being able to do that and hopefully come back with some great news. Thank you very much again for the time, for the opportunity to speak. I'm delighted to take as many questions as you have, and thank you.
Great. Thank you, Dan. Yeah, sheesh, that was quite a lot to absorb. Incredibly informative. I certainly hope that you're right on the energy stocks. One of my big holdings in my own portfolio is Cecil. And
I don't know about that one. Just to be clear, I don't know about that one. That's
yes. But yeah, I think very interesting insights. Economists have forecasted 22 of the last 6 recessions. So their track record is not great. I think from a timing perspective, I haven't seen any questions on the Q&A.
Okay. Stunned everyone into silence.
Yeah, we have gone a bit over time, and. Yeah, I think from our side to the speakers, Dessen, to yourself, Dan, I think you guys have the eternal Chinese curse playing out in the UK. May you live in interesting times. It's certainly incredibly interesting in the UK at the moment. Rishi Sunak went to meet Prince Charles, and he walked in and he said, "Hi, I'm Rishi, I'm Liz's replacement." And Prince Charles said, "Yep, same here."
So very good. Yeah. I haven't heard that one before. I'm just relieved you didn't mention the lettuce.
The lettuce? No. We've moved on from the lettuce. We're on to fresher material now. But thank you very much to yourself, Dan. We will not forget you on your 25th anniversary. We will be sure to invite you back. We have the best wines at our investment conferences, and I'm sure you would love to
sign me up. Where do I sign up? Thank you.
Now we've put you down. Dessen, if you're still online, thank you very much for your contribution. And to our clients, thank you. We appreciate the time that you've given, and we look forward to seeing you all in person next year. On that note, thank you all, and enjoy the rest of the day.